discuss all of that with Geoff Dennis, the independent emerging market commentator as well. Geoff, hi, good morning. Thank you so much for joining us on ET
Good
Now.
morning.
First up, just wanted to understand what was the key takeaway from the Fed commentary yesterday for you? What really stood out?
Well, I think the thing that stood out is the two obvious things, which is, first of all, Powell confirmed that indeed the disinflation process has started. That's very clear because inflation peaked at 9.1% several months ago and is now 6.5. And although core inflation has hardly come down, it has come down a bit. You can clearly see the disinflation process has started. So the market liked that, although quite why they were surprised by that, I don't know. And then the second point, the second clear takeaway is he was hedging his bets a little bit on how strong the economy is because of this extraordinary employment report that we had on Friday, which is really, is really sort of unsettled everybody. Nobody quite knows what it means. So I think you're getting what you want, which is lower inflation. Wage inflation is behaving well. But the labor market is puzzling people. And so there is a fear, I think, out there that the Fed will have to do more than anticipated previously if that labor market strength eventually causes inflation to go back up again.
Do you think it's too early, Dennis, to say that Fed has managed a victory against the inflation?
Oh, no, I don't think it's too early. I think it's definitely gaining a victory. I mean, there's some way to go. I mean, I ran some numbers today. If you get 0.3% inflation per month over the next 6 months, inflation is at 4.7 by March and 3% by June because the base effects, the comps are so relatively good. And so I think there's going to be the usual shifting around, or gasoline prices are probably going to be pushing inflation up in January, then pulling it back down in February. Food prices are coming down. And obviously what Jay Powell is most concerned about is still services inflation. But frankly, I think inflation is on its way down in the US. And my own view is that there's no guarantee that the two further rate hikes of 25 basis points that the Fed had penciled in last meeting, there's no guarantee that that's going to change. My gut feel is that's still going to be the case. We'll get two more rate hikes to 5.25. What I think the strong labor market does is probably make rate cuts later this year, which I never thought would happen anyway, extremely unlikely. But I think I'm trying not to be put off by this strong labor market. I still think the whole story is intact with inflation coming down and the Fed nearly finished with its tightening.
So what's your outlook then, Geoff, as to what you expect the trend in terms of the US 10-year yield, largely on the basis of the kind of commentary that we've got and what you're expecting ahead from Jerome Powell?
I think we've seen a big sell-off. We've seen yields rise by about 25 basis points over the last few days. I think once again, I think you buy the bonds back. I think it's, you've had that sell-off, and I think next week we're going to get another very good inflation number, which is going to pull the year-on-year rate down as far as I can see anyway. So I think bond yields are going to start to go down again. And I think also the dollar will start to go down again. Dollar's rally about 2 to 3% of its low, which has contributed to emerging markets pulling back a little bit over the last couple of weeks or so. So I think you'll get all those trends looking quite good over the medium term, if you like. If I can just say this as well, I think the most interesting thing what's going on here is the behavior of the labor market. Frankly, I don't really believe that 517,000 job growth that was reported for January. I think it sounds very freakish. January is often a surprisingly strong number that's out of line with consensus. I think it may well get revised down sharply, or it may well be followed by much, much weaker data in February. And I think the seasonal adjustment factors have played a role there as well. In other words, I think over the next month or two, it'll become clear that the labor market is not as strong as that data would indicate. And in that event, I think you buy equities, I think you buy bonds, I think you sell the dollar, and I think emerging markets will continue to, will begin their rally once again, and you'll see emerging markets having a nice year in 2023.
Okay, on that optimistic note, Geoff, we'll let you go. Thank you so much for joining us. Emerging markets